What if you could start investing with just a few dollars? You can, and those small steps can grow into real wealth over time. The problem most beginners face is thinking they need a big balance or perfect timing. You don't. Starting small is about low costs, broad diversification, and steady contributions you can actually keep up. Time in the market matters more than timing the market, and simple habits beat complicated moves. Here's the core idea: make consistent, affordable investments and keep fees low. Many brokerages now offer fractional shares, commission-free trades, and automatic deposits. That means you can begin with $5, $20, or $100 at a time and still build a diversified portfolio. A simple path is broad market index funds, or ETFs. These track large swaths of the market, give instant diversification, and usually have low expense ratios. Buy small amounts on a regular schedule and hold for the long term. Expect ups and downs. Volatility is normal in the short run. If you want a one-and-done setup, target date or asset allocation funds bundle stocks and bonds and adjust over time. One purchase can keep you diversified and rebalanced. Just confirm the glide path fits your comfort with risk and check the total fees. Prefer automation with guidance? Robo-advised portfolios build ETF mixes based on your goals and risk profile. They handle rebalancing, and some even do tax loss harvesting. Watch for advisory fees on top of fund costs, and remember the allocation is designed to be generic. To dial down volatility, add government or investment-grade bond exposure. Bond ETFs let you buy in small amounts and help stabilize a stock-heavy portfolio. Know that bond prices can fall when interest rates rise, and corporate bonds carry credit risk. Curious about dividends or factors like value and quality? Factor ETFs can tilt your returns and income. Start with a broad core, then add targeted funds slowly if you choose. Styles can lag the market for long stretches, so patience is key. Pick the right account for your goal. Retirement accounts can offer tax advantages and, in some workplaces, a valuable employer match. Taxable brokerage accounts are flexible, but tax dividends, interest, and realized gains. Your practical next step: choose one simple, low-cost option, turn on automatic contributions, and stick to a schedule. Review fees, stay diversified, and let compounding do the heavy lifting. Want the full walkthrough, comparisons, and FAQs? Read the full article at finlitica.com.